And welcome back. This is the weekly economic update for August 2nd, 2021. Hope everyone had a great weekend. It was pretty nice here in Colorado. Had some cool weather. It was in the 60s Saturday and Sunday, which was really nice. Got a little rain, but over here on the Front Range, we didn't get too much flooding like in the middle of the state, so not too bad. So, all right, like I said, I hope everyone had a great weekend. Let's go ahead and take a look at the weekly update. All right, so the week on Wall Street, the stock market posted small losses last week despite a very strong showing by corporate America. The Dow Jones slipped 0.36, the S&P lost 0.37, NASDAQ was down 1.11, and international was actually up 1.51. So if you remember the week before, domestic stocks were up, international was slightly down. This last week, kind of the reverse. Stocks take a breather. There were plenty of excuses for stocks to retreat last week. News of a new phase in Chinese regulators' crackdown on large private sector companies, a decline in new home sales, and concerns about the Delta variant weighed on investors. After opening the week, adding to record highs, stocks turned lower despite an earnings season that continued to impress. Solid earnings from mega cap technology companies were not enough to propel stocks higher. Instead, stocks slipped throughout the week, fighting uncertainty over Chinese stocks, a disappointing second quarter GDP number, and a retreat in technology shares that they reset to fresh company guidance. All right, so Chinese technology stocks were under pressure last week as Chinese regulators continued their push to rein in large companies for reasons that include data security, abusive corporate behavior, financial stability, and curtailing private sector power. Chinese government actions raise new level of concerns about which industries may next fall in the crosshairs of regulators. American investors have plenty of exposure to Chinese companies. Substantial losses were felt by mutual funds and hedge funds, which account for about 86% of the holdings over 200 U.S. listed Chinese companies whose aggregate market cap exceeds $2 trillion. So, all right. So let's see, we got some economic data coming out this week. Today is the ISM Manufacturing Index. Tomorrow, factory orders. Wednesday, we have the ADP Employment Report and the ISM Services Index. Thursday, jobless claims. And Friday, Employment Situation Report. Got a bunch of companies that are reporting earnings this week. We got Simon Properties today. Tomorrow's Alibaba, Activision, Amgen, Eli Lilly, and Diageo. Not familiar with that company. Wednesday, Roku, Prudential, CVS, General Motors, Etsy, Electronic Arts, MGM. Who else? Match.com, Emerson, Bookings Holdings. And on Thursday, we got Square, Illumina, I'm mispronouncing that, Duke Energy, Albemarle Corporation, Cigna, Becton, Dickinson and Company, Regeneron Pharmaceuticals, and on Friday, Dominion Energy. So that's what's going on right now as far as the weekly update. I have two white papers going out this week. The first one is Teenage Wageland. This basically, talks about how, with summer jobs, you got a lot of, student workers out there. And in May, leading into summer months, 33.2% of working teenagers were part of the workforce, so about a third. The hospitality industry, including restaurants and hotels, is still struggling in the wake of COVID-19. They have faced particular challenges in staffing and has turned to hiring younger employees in particular. I think this is a great opportunity right now for younger folks. I mean, if older people are going to sit around on their duffs and collect unemployment, hey, go out there and get some experience in real life and get ahead of the schmucks who would rather sit around and be lazy. So, it finishes off just, asking, how might, when students go back to school in the fall, how's it going to affect, the service industries? Is it going to lead to higher unemployment? We'll see. I know myself, I worked all the way, from the time I was old enough to have a job, I worked and went to school at the same time. I worked a little less during sports and things like that, but I still held down a job, which wasn't that hard to do. I mean, you can easily get 20 or 30 hours, working weekends or in the evenings. and it's just good. It's just good job experience. So, all right, next one. No, this is the wrong article. Let's see here. Let me go back and find it. Here we go. And the next one is, I linked the wrong article. Chinese stocks are under pressure. Basically, like we just talked about, how with the Chinese regulations, it's put a lot of pressure on Chinese companies or U.S. companies in China. And I'll go ahead and fix that link for when it goes out in the email. So I apologize. Alrighty, so I had a couple articles I did want to touch on. This first one comes from Brian Westbury at First Trust Portfolios. The title is The Seeds of Stagflation. Starts out last week, the government reported real GDP in the U.S. grew at 6.5% annual rate in the second quarter and was up 6.4% at an annual rate for the first half of 2021. Real GDP is now 0.8% larger than it was at its peak prior to COVID. The problem is that getting back to where we were just prior to COVID is a low hurdle to clear. Real GDP would have grown much faster if COVID hadn't happened. In other words, the economy is smaller today than it would have been in absence of COVID. So, if we hadn't taken a 15-month do-si-do backwards, then the economy would be heads and tails above where we are today. Again, assuming that we didn't have some sort of a market correction or a recession or something else. But all things being equal, if you were to remove the COVID out of the equation, the assumption is that we would have our economy would be in a much better spot today than where it is right now. I think that just goes without saying. What's more interesting is that when we measure the economy in terms of volume of dollars being spent, nominal GDP, which reflects both the real GDP and inflation, we're already very close to where we'd be if COVID hadn't happened. Nominal GDP is not only at a record high, but it is up 3.1% annualized pace since late 2019. So how is it possible for the total amount of spending is close to normal, but real GDP is still below par? It doesn't take a PhD in economics to figure out that inflation is the difference. Since late 2019, GDP prices are up at 2.7% annual rate. And yes, that includes the steep drop in prices early in 2020 during the onset of COVID. GDP prices grew at 6% annual rate in the second quarter and at the fastest pace since 1981. The rise in inflation is what you get when the government implements an unprecedented level of stimulus to support incomes while implementing policies like shutdowns and overly generous unemployment insurance that stifle production. It's what you get when demand outstrips supply, and this is exacerbated when the central bank prints excess amounts of new money. Inflation has arrived, and it's not just transient. So there's a little more to this. I'll attach it to the email that goes out, but certainly not a good situation that we're currently in. It's kind of in a rock and a hard place. The Fed and those idiots in Washington. If one, even if just a few were to say, "Hey, we got to tap the brakes here, or else we're going to drive this car right off the cliff, Thelma and Louise style." So, I haven't seen anyone talk about it. When I look over at the TV, at the business channels, all I see is more stimulus, more this, more that. But I think it's unfortunately going to take some sort of calamity for anyone to pull their head out of their ass. Excuse me. All right. This next article is actually it's what's the date on this? June 3rd. So it's about 2 months old, but the title of this is Millennials Are Running Out of Time to Build Wealth. I don't necessarily agree with that. Most millennials are under the age of 40. If you're going to live to 90 or 100 years old, there's time, but you need to start planning now. But what this breaks down is, the average millennial at age 40 versus a boomer at age 40. What the cost of college was comparatively, $24,000 for a year versus $10,000 for a boomer. The percentage that own homes at age 40, 66 versus 61. The cost of a home, $216 versus $328. Net worth, there's a significant drop there, and the percentage that owns stocks. This next chart shows, boomers, Gen X, and millennials as far as, what their incomes were, what their median wealth was, and then also what their debt is now. So, there has been a shift from, having assets, 30 years ago versus today, where, millennials have, an exceedingly high amount of debt, mostly due to college, and probably credit cards are more accessible today than they were 30 or 40 years ago. But it certainly is a problem. I think a lot of it is just they've gotten behind the 8 ball and feel like they can't get ahead. So hey, they throw their hands up and say, "What the hell?" All right. Next article is from the Center Square. Its title is 1.9 million households owe $15 billion in back rent as eviction moratorium expires. It expired on the 31st, which was Saturday. And, there's quite a bit in back rent that's owed. So this is, again, what could be the next shoe to drop, whether or not it's, a lot of, homeless people due to people getting kicked out on their cans, or, whatever the situation might be. So I'd keep an eye on this and see where this goes. Granted, we've been paying, the government's been paying out unemployment for the last year. So I'm not sure why so many people are behind on their rent. I'll take a guess and say that most of the people spent that money and figured, hey, I'll just put it off as long as possible. And now the day of reckoning has come. So I don't really feel bad. Unfortunately, it makes a nice scare tactic article. It makes a nice, something to talk about in the news. But if you're going to live somewhere, you got to pay for it. That's just the way life is. All right. And then the last article is, all these, stimulus and, bills that were done over the last year to help out the economy. They're coming to an end. The next one is, this is from CNBC. There's an unemployment cliff coming. More than 7.5 million may fall off. I don't know if I'd really call this an unemployment cliff, because most of these people have been collecting unemployment for well over a year. And now that the benefits are going to end at the end of the month, I guess Labor Day is the cutoff. They're going to, either have to go out and get work or starve. So, like I said, I'll share this with you. I've been talking about the unemployment rate every week, talking about it in my videos as far as, what the changes are. Just from my own out driving around, going from place to place, people are hiring. Whether or not it's a job you're willing to accept, that's another story. So I would suggest if you don't like the skills that, or you don't like the wages that your skills provide, you might want to have some better skills that pay better. So, all right. Well, that's everything I had for today. So, a lot of negative news right now with, moratoriums expiring and unemployment benefits coming to an end. But if this isn't a reason to, give someone a swift kick in the ass to get out there and get back to work and take charge of their life, hey, it's sink or swim. But that's everything I had for today. So if anyone needs anything from me, feel free to give me a call or shoot me an email. I'm here all week. I don't have a lot of meetings. So if anyone needs anything, I should be able to get right back to you. So hope everyone has a fantastic week, and I'll talk to you later. Bye-bye.